Good afternoon. It's Jeffrey Christian from CPM Group. It's Friday, the 18th of September in the afternoon. Few comments that I want to make about some of the developments that we're following and chasing down in the precious metals market. But first, I think overall what we're looking at are precious metals that are showing a lot of resilience to any weakening over the last several trading days. Gold and several other metals moved sharply higher in early August. And while they've come off a little bit, they seem to be forming a firm base. Our expectation is still that prices move higher. I think the next 4 months are going to be extremely volatile from an economic and political perspective, that the COVID-19 pandemic is not over by a wide margin, and that there could be some setbacks that sort of shake people's confidence in the economy and perhaps political leadership in certain countries. Brexit's still coming down the road. That's a problem for Britain. It's a problem for Ireland. It's a problem for all of Europe. You have other issues in Europe. You have issues in China and other countries. And then you have the United States, which, let's be honest, is the elephant in the room. We have the election coming up. We'll have the post-election fight and brawl on the parking lot. We're not quite sure how it's going out. CPM Group is actually working on a special report right now on the potential impact on precious metals of the elections. And we have 4 different scenarios, depending on what happens, not only with the presidential election, but with the senatorial races and the congressional races. So we're working on that. But we think that the volatility in the political and economic and social macroeconomic environment will be such that they're going to keep gold and silver in investors' eyes. We wouldn't be surprised to see gold rise sharply over the next 6 weeks or longer through the rest of the year, and we wouldn't be surprised to see silver rise sharply too. Platinum and palladium are slightly different because they're industrial metals, but we are seeing some interest there. I wanted to talk a little bit about what we're seeing in terms of structural changes in the ETFs. We've noticed, and I think I've mentioned it in previous recent conversations, there's 27.9 million ounces of gold that have been added to the gold ETFs so far this year. A lot of that was, well, most of it was between March and July, and a lot of it was in July and June. We had about 332 million ounces of silver added to silver ETFs. Investors have never bought 330 million ounces of silver, and in 27 million ounces of gold ETFs is a lot of gold into the ETFs. And we started to realize that that possibly meant that there were other buyers of ETFs. Now, the way ETF shares are made is that someone goes to an authorized agent of the ETF manager and says, I have 50,000 ounces of gold. I want 500,000 shares of your company. And my 50,000 ounces are deposited in a London depository that you use as your depository for the gold that's there. So the way the metal gets added to the ETFs is the creation of new shares, and those new shares are paid for with physical metal. I've talked in the past about the fact that 2017, 18, 19 has seen a lot of investors selling a lot of gold and silver back to market makers in London. We saw gold inventories and probably silver inventories reach record levels by the end of 2019 in London. And then March happened and they surged even higher. We started to suspect, and then we had confirmed from various bullion banking sources of ours, that what we were seeing were bullion bankers who were buying this metal and holding it on their books as market makers, were swapping out some of their physical gold and silver for ETF shares. We thought it was a matter of internal policies, but as we have continued to investigate it, because we're trying to see how much of this metal was bought by bona fide hedge investors and how much of it was market makers, what we found was that you had record volumes of metal, you had sharply higher prices, you had sharply higher volatility of those prices, and a lot of those market makers are bullion banks, senior management of whom had said, let's get out of metals trading or let's cut back severely. So as senior management and the credit departments were saying, we really need to either get out of or reduce our exposure to precious metals, the exposure was rising and it was becoming much more volatile. And it seems that what happened was that some of the banks were very close to reaching regulatory limits in terms of the volatility of their assets under management or their assets that they were holding. And they needed to do this. So we're continuing to study this, but that has important implications, not only for the precious metals markets. And, first off, investment demand's not as high as one would think if one thought that all ETFs purchases were investors. Second thing is that you have the banks having so much of their assets in gold and silver that it actually would come into play and be noticeable and problematic in their value at risk and other calculations. And the third thing is that it suggests that precious metals are much more important to banks than we thought. Also speaks something about the stability of the banking system, which is good for gold and silver in the long run. So we're continuing to look at that. It's a pretty important thing. It's a very interesting thing. And it's something that the precious metals markets ought to be paying attention to, but don't seem to have caught on. Central banks, very quickly, 7/8 of the gold that's been bought this year by central banks has been bought by the Bank of Turkey. It's got its own issues. A lot of other central banks have pulled back. Russia because of the oil price war. Other central banks have pulled back because the price of gold's higher and they just don't want it. And or because they're looking at their economic situation and they'd rather have their monetary reserves in dollars and more liquid assets. So there are a variety of things going on. We produced a market commentary this week on rhodium. The rhodium price has risen very sharply. If you look at current prices and you look at annual supply of rhodium, platinum, palladium, gold, and silver, the dollar value of annual supply for rhodium is roughly double what the dollar value of annual platinum is at current prices, not at last year's average price. Rhodium is much more important, and it's much more important to producers and refiners, and it's also very important to the auto industry. The market looks very tight, and so we've been writing a little bit more about that than usual. Those are some of the things that are occupying our thoughts this week. We're also working a lot more on the normative role of gold and precious metals and commodities in diversified portfolios. And we're doing that because, quite frankly, a number of clients are saying we really need a lot more work on the normative role of precious metals in diversified portfolios. That's work that we'll be focusing on over the next several weeks. And in the meantime, we'll keep you posted on what we're thinking. Have a good weekend and stay safe.